All right, welcome back to capitalcompetent.com. Today we are going to go over one of the most important metrics you should look at when you are informing and educating yourself on a decision to buy a company in the stock market. Okay, this is going to be a jam-packed video where I'm going to explain price to earnings, and I'm also going to give you two real case scenarios so that you can decide whether a company is a good investment or not. This is one of the most important metrics, okay, because it can tell you, it can inform you if a company is overpriced or underpriced. Okay, it's not the only metric to look at, but it's one of the most important. Okay, now we're going to start off with why it is and how it's important. Okay, when you are buying a stock, you are buying a piece of a business. A business, all it is a stream of income. Okay, um, we are in America, I'm assuming, so we buy stuff in USD. Okay, so when I buy a piece of a business, I'm buying a piece of that income stream. Okay, if you truly break it down, that is all a company is. Okay, I can open up a hot dog stand outside my house, and if that brings in $1,000 every month, that is valuable. Apple, one of the biggest companies in the world, they bring in 300 billion. Okay, obviously, one is worth more than the other. However, at the end of the day, if you buy shares in my hot dog stand or you buy shares in Apple, all you are doing is buying a piece of that income stream. My hot dog stand makes $1,000 a month. Apple makes 300 billion. Okay? When you buy a company, it's just a piece of an income stream. Now, you can always overpay. Okay? If you are all you're doing is paying for an income stream, you can always overpay. You can pay 10 times, you can pay 100 times, 200 times. Okay? But the higher PE that you pay, the higher you are paying for those earnings and the less likely your returns. Okay? Again, we're going to go over to a company is only valuable if it helps humanity in some way. Okay, my hot dog stand provides food, so people are willing to give me money for that. Apple creates amazing devices that all integrate together and are an ecosystem. It's one of the best products out there. Okay, you're willing to pay a lot more for that privilege. But at the end of the day, it's all an income stream. Today, I'm going to do something really cool is I'm going to show you two real life companies and then I'm going to reveal those companies and you tell me what you think. After everything, you tell me what you think is a good buy. Okay. The price to earnings is how much you are paying for those earnings. Okay. You can look at current and forward. So let's go over two real life ones. Okay. Company A. It has a trailing 12-month earnings of $8 billion. That means over the past 12 months, they earned $8 billion. Company B, okay, the past 12 months, they earned $16 billion. Okay, so obviously company B is bigger, right? The free cash flow is essentially how much cash that they bring into their earnings, how much of that cash is not tied to anything else. That means paying off debt, investments, insurance, all that good stuff. And how much of that is free and not tied to anything else. So the trailing 12 month for company A, they have $4.4 billion generated. Company B has 6.8. Okay, so they're a lot closer than you think. Okay, they're in the billions. Yes, $2 billion difference is huge, but when you're talking about multi-billion, even trillion-dollar companies, they're a lot closer than you think. Okay, Company A's current PE is 10 and a half times. So essentially, you're paying the current stock price for that piece of income stream, you are paying 10 times the current price. The forward PE is 12. Okay, when there's a difference between current and the forward, if the forward P is higher, that means that their revenues are likely, excuse me, their earnings are going to be declining. Okay, very important to think about. Company B, okay, Company A is obviously a low PE. Company B has a current P of 196 times. So that means you're paying 196 times its earnings to buy one piece of that stock. Now their forward PE is lower, so that means company P is growing. Okay, it's important to think about. These numbers are all publicly available. This is all on Yahoo. This is all on Google. You can Google and look and research yourself. Okay, but remember, a company is only an income stream. That's all it is. This one, they're similar companies. Okay, this one's obviously bigger. This one is uh, not growing, and this one is growing. But I want you to look at the PEs. What does this mean? Well, for company A, you can buy its income stream for 10.5 times today. That means if they made, just like my hot dog stand, if they made $100,000 a year, you would have, if you wanted to buy that whole company, you'd have to pay $1 million. Let's go to company B. You can buy company B's income stream today for 196 times. That means if they, that means if they made $100,000 a year, you would have to pay 19.6 million to buy the whole company, to buy every share. Which one is the better deal? Which one would you likely buy? If I bought company A, I would only have to pay $1 million. If I bought company B, I'd have to pay 19.6 million. Which one is the better deal? Well, you have to remember one is growing and one is not. But it's all about PE. How much do you pay for an income stream? Let's talk about growth rates. A growing company deserves a higher PE. But what you have to watch out for with these growth companies is that you can overpay exorbitant amount of money for something that is not growing very highly. If a company's income stream continues to grow, then yes, it is worth more today than a company that doesn't grow. Your goal is to analyze companies logically. The future is not guaranteed and many businesses are unproven. One can get run up way too high. Remember, a business is just an income stream. That is all it is. If I have a hot dog stand to my right and a hot dog stand to my left, okay, one makes $1,000 a year and will make $1,000 forever. The one to my left makes $1,000 a year and will make $10 more a year every year. Obviously, the one that makes $10 more a year, so the first year makes 1,000, second year makes 1,010, second year makes 1,020, I will pay more for that. How much more am I willing to pay? Is it 200 times? 400 times? 500 times? Remember, would you rather pay $19 million for $100,000 a year, or would you rather buy $1 million? We'll see. So the price to earnings ratio is very important because it helps you make a better understanding of what you should pay. Today, the S&P 500 is trading around 25 price to earnings, which is historically very high. Now we are in a quote unquote overvalued market, so you can use that as a relative number. So relatively, this company is cheaper. It's trading at 10 times. If the market is trading at 25 times, this is relatively cheap and this is relatively expensive. Now your job is to use that and see if it's an informed decision. So let's look at these two companies. Let's do a review. Company A is Target. Company B is Tesla. The company A is a $40 billion company. Company B is a $1.1 trillion company. Now, what will do better in the long run? Well, I can't predict the future. You can't predict the future. The only thing you can do is decide whether you are willing to buy an income stream for its current prices. Everything is Mr. Market is going to try and sell you or try and buy from you every single day. You have to look at what you own or what you're willing to buy and say, is this a good decision? If there is a company that's $100,000 a year today, and Mr. Market wakes up in the morning and says, I'll give that to you for $1 million, or you can have it for me for $1 million. But then tomorrow, he decides that it's $19 million. Somewhere in between is what you're willing to buy. But you can always, always overpay. You can use price to earnings to help you decide if something's a good buy or not. Because you can't predict the future, but historically, if you overpay a company, your investment will underperform 9 times out of 10, almost 10 times out of 10. The short run, it can go anywhere, right? News can hype it up, people can hype it up, right? But at the end of the day, the rubber will have to meet the road. It is an income stream, it has to show numbers. If something is trading unbelievably high and it gets to that next year and they don't perform, it will come crashing down. It has done this time and time again. Done it in the internet bubble, it's done it during the housing market, did it in 1987. Back at these periods of times when we were historically overvalued and see how badly that turned out. Now, the upside of each company's, right? When you're trading 200 earnings, that means it has to grow 10 times next year for it to be worth what it is today, just to match the market's price of today of 25 times earnings. Do you think that's possible? Is this a good deal? That essentially means that Tesla would have to grow its revenue to $1 million a year if it was making $100,000 a year. How would it be able to do that? Is that reasonable? Is that logical? It's up to you. Okay.